The benefits of real estate comparatively outweigh just tenfold compared to every other type of investment, because not only do you receive cash flow and appreciation if you're in the correct market, but you have tax advantages that you do not have with any other asset classes. So you can shelter that income, so you can make the income without paying taxes on it. And then you can also sell it and defer capital gains taxes, which you can't do on any other asset class. And so when you combine all of those together, like your example, maybe your yield, right, or your total return is X, but when you factor into the tax advantages, it could be twice that.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
I am so excited because today I have Andrew Westling with me. I know, I kept trying to say the W, but it doesn't fit. It doesn't fit. I want to read you his bio, and then we can welcome him to the show. So Andrew is with Walker and Dunlop. He is the Associate Director of Capital Markets. Andrew Westling, Associate Director, is responsible for new loan originations and closings for multifamily and commercial properties nationwide, which is why I would have him on my show. Mr. Westling is based out of Walker and Dunlop's Los Angeles, California office. Throughout his career, Andrew has underwritten and closed more than $1.1 billion in debt and equity financing for multifamily, industrial, retail, office, hotel, manufactured housing, and self-storage properties across the country. Prior to joining Walker and Dunlop in 2016, Andrew served as a director for the George Elkins Mortgage Banking Company, GEMB. Preceding GEMB, Mr. Westling served as a vice president for the private bank at Union Bank for 5 years. Within the private bank, Andrew's responsibilities include originating and structuring custom credit solutions for his clients, including commercial and real estate financing, asset-based lending, and cash flow for secured credit facilities. Andrew earned his Bachelor of Science in Business Administration with a dual concentration in finance and accounting with the Questrom School of Business at Boston University. Andrew, welcome to the show.
Thank you for having me. I'm excited to be here.
Okay, say your last name, because I feel like I said it like 5 different ways every time I read it.
Sure, it's Andrew Westling. It's spelled like wrestling without the R.
Without the R.
But
Westling.
it's the most common mistake I get is Andrew Wrestling, and I have no problem with it.
And what's funny is, of course, I've seen your name multiple times. I've talked to you multiple times. You think I would understand how to say your name correctly after having talked to you so many times, but I'm just going to call you Andrew.
And I'm okay with that.
And you're at Walker and Dunlop, so
just
people
don't call me late.
Just don't call you late, and don't miss dinner, right? It is good to have you here. And the thing that's not in your bio that I think is important that people will probably get a chance to get a sense of for you is part of why I invited you to the show is because I also consider you to be a bit of a data head. And I am partial to data heads. I have to confess, I would almost say I have a crush on data heads, but I'm married, so I can't really use that word. But the fact is that I really, really appreciate data heads, because in the field of real estate, data is one of the primary ways that you can make sound directed decisions. If you run on your feelings, if you run on your emotions, if you run on the word in the market, you just might really have a pretty good chance of just going wrong. When everybody's investing, including my parents' gardener, who bought 4 properties in 2005, you start to understand that maybe the market isn't really in a good position for you as an investor. And the way that you know that is not because of the news on the streets and not because of everybody's excitement and enthusiasm. It is the data that tells you you're getting to a precipice. And that's what we need to know. So thank you for your deep love of data.
It's my pleasure. What I would say, just to follow that, is if you have data that others don't, it can be a huge advantage, because real estate in some degrees is not a zero-sum game. There are winners and there are losers. And using that data to your advantage can put you in an optimal position to succeed in your investments.
It can, although I have to confess my club is as much about sharing data, right? So it does. And so, you want to talk to experts like people like you who do have the data. So,
and we share it with all of our clients, and we are happy to.
yes, and you do share it with all your clients. And I know you share it when you speak at clubs as well, easily, gracefully. So I know you clearly, it sounds like in your background that you've kind of been in real estate and finance since you were like 2. So
I've always touched real estate throughout my finance career. But when I was with Union Bank and their private bank, it was really a small piece of the pie for me. I was also licensed and with my Series 6, 63, 65 and California insurance licenses. So we were selling investment products, which was a much larger piece of our business. But real estate finance was something that really stuck to me. In fact, I was networking internally within the bank, trying to actually shift my career into real estate finance full-time for the bank. But there just wasn't enough opportunity internally, and that's what actually led me to leave. I had a wonderful experience, made some great friends and colleagues that I keep in touch with at Union Bank, but I really made a decision because real estate really resonated with me, and not just real estate itself, because I think there's something just magical when you can be a part of a project to see it come to life and touch it and feel it. Mm-hmm. But also the thought process of real estate investors and developers really just having that vision of creation and inclusion, and doing right by a community and providing housing for people that don't. It just there's so much that just resonated with me that I knew that I wanted to make this my full-time career. And starting in banking was one of the best building blocks and foundational places I could have been, because I learned so much about credit and underwriting and leverage and responsible leverage. And I've seen both the good sides and the bad sides of it, and workouts, et cetera. And so having that knowledge was actually the perfect springboard to get into the real estate finance world full time. And so I think it was actually a pretty natural step, but as my wife will attest, I'm just an absolute junkie when it comes to real estate deals, real estate transactions. I can't get enough. I am absolutely addicted, and I love what I do.
Clearly, every time I've seen you, that seems to be the case. You are on it, in it, talking it, breathing it, engaging in it. And, even after meetings, we will have, conversations about it, and you will continue on. I consider myself a bit of a real estate junkie. My husband will do something very similar. We go to just a random party or random gathering back when gatherings were happening, which they will happen again. And I'd hear real estate somewhere, and I'd be like, "I'll be back, honey." He's like, "No, you won't. I'll see you in a couple hours." I'm like, "Yeah, what can I say?"
Sometimes our weekends we'll drive around and go to open houses, and we are happily in our new home. We are not looking for a house, but right. We just love going to see what's out there and getting inspired and seeing what other developers are doing and how they're transforming communities. And it's just we are passionate about it, and we love it.
What's funny is I'm just as guilty, because, I will, for any reason, like somebody will say, "Oh, what about, I'm looking at buying something over here." And I'm like, "What's the address?" I'm not going to drive by it, but I'm going to look on, whether it's Zillow or Redfin or Truly, I'm going to look at, what's around it and what is it? And like do a little market research sort of as quickly as I can to sort of get a sense for it, just because I love understanding markets, not so much just real estate and that asset itself as the asset inside of the market is what seems to, excite me, because that's where I feel like the differential is where you can make the difference, right?
Absolutely.
So it's the distressed with the property. It's whatever the D is, right? The distress or the differential or the disaster or the dynamic, right? Pick your word. And that is really where the value add is on the property.
And it all comes back to data.
And data. That's right. And it all comes back to data. Oh, see, I told you. So you're with Walker and Dunlop right now. Tell me a little bit about what they specialize in. I know you've got the WD 2020 shirt, so you can, touch on that too. And then I'm going to go back to the topic of, I think you call it responsible financing. Is that what you call it? Because I think that's very important that people understand what that means, because a lot of new investors do not have a clue as to what that means. So let's hear a little bit about what you're up to with Walker and Dunlop, and then I'll ask you some more questions.
Sure. So Walker and Dunlop as a firm is a national commercial real estate finance and investment sales firm. So we have two real silos of business. One is the financing portion, and one is our investment sale portion, where we are brokers listing multifamily properties for sale on behalf of our clients who are selling them and purchasing them. I do not do that part of the business, but I work closely with our team of brokers across the country. What I specialize in is our financing side. And within that financing silo, Walker and Dunlop is a diversified vendor, meaning that we really wear three hats. We are a direct lender, we are what's called a correspondent lender, and then we are a third-party broker, just an intermediary, either securing or finding third-party lenders and then placing the debt on behalf of them for our clients. So as a direct lender, we are a Fannie Mae and Freddie Mac lender. And a lot of your, I'm sure, listeners will have heard Fannie Mae and Freddie Mac because they are really the largest source of financing for real estate in the country. But most of your listeners are probably familiar with Fannie and Freddie because they provide single family home financing.
Exactly, on the residential side, not on the commercial side.
Exactly. But they also have a commercial side where they finance all things multifamily. So for rent apartments, which are market rate, affordable, seniors housing, students housing. They also will finance some assisted living and independent living facilities.
Okay.
And so manufactured home communities are a big part of our business. And so through Fannie Mae and Freddie Mac that guarantee those loans, we are a direct lender, meaning that we underwrite, we make the credit decisions, and then we fund the loan, and then we also service it and hold it on our balance sheet essentially for the life of those loans.
Okay, and that's residential only. It's any form of residential, just like you went through, but really it's not industrial.
Correct.
It's not, it's not.
When we're talking about
warehouse.
Fannie Mae and Freddie Mac, we're talking about for rent housing. And to qualify as commercial for rent housing, it has to encompass 5 units or more.
Right.
Anything that is 1 to 4 units is residential, still can be financed by Fannie Mae and Freddie Mac, but a different side of the house, and Walker and Dunlop doesn't play in that pool.
Right.
Interestingly enough, one thing that we're seeing a lot of right now, especially through the pandemic and sort of the demand that it's driven, is developers who are building to rent. And so what we've typically seen is, across California, Texas, Florida, these where people are moving to because developers are building houses. Those developers are now building them specifically to rent and not to buy. So they're building the same floor plan, the same homes, but they're building entire master plan communities of rental homes. So that's been a big shift in the market, and one that Fannie Mae and Freddie Mac participate in. Okay. So even though they are individual residential homes, when you finance them as a group and they are specifically built for rent only, they actually qualify as commercial for rent multifamily, interestingly enough.
That is interesting. And that is interesting that is a trend that is going on right now, because the whole concept of building for rent, having good quality rental units, not even just in California, having that outside is a whole deep conversation by itself. I don't know if we'll have time to dig into that, but I think it's a good conversation. So you had 2 other arms. So you went through 3 arms. So let me let you have the space to finish the other 2.
I appreciate that. So again, as a direct lender, Fannie Mae and Freddie Mac, we are a direct lender of multifamily housing across the US, and we are one of the largest. In fact, with Fannie Mae, we are their largest lender, and we were in 2019, and I believe we're on track to again be in 2020. And earlier this year, we increased our market share with Fannie Mae to nearly 20%, meaning that 1 in 5 multifamily loans that were originated through Fannie Mae or guaranteed by Fannie Mae was originated and secured by Walker and Dunlop.
Okay, so this is my impressed face. I am seriously impressed with that, because that is a large volume, right? I mean, it's not just a good relationship with Fannie Mae, it is a large volume of actual processing, whether it's paperwork or sales or underwriting and data finding. That is a very large volume.
You can imagine on a scale, last year we did about 32 billion in total debt originations.
Okay.
And yet we have less than 1,000 employees. And so many of our competitors like CBRE, JLL, HFF, right? These massive international conglomerates who have hundreds of thousands of employees, and yet we're competing on a scale with them. So it allows us, the beauty of Walker and Dunlop is that we are a very small feel company, which allows us to be very nimble and very client centric.
Yep.
But we have all the toys and the capabilities of all of our competitors, and yet we compete at a first-rate basis.
Well, I can definitely confirm for the small feel. You guys feel very approachable. I know that you're very available, that you have a high level of customer service. You have a very good level of character and relationship to serving your customers well. Like, I'm real familiar with that. Thank you. I know many years ago that thing didn't work out, but your availability and being able to help us was wonderful. So I know that there is definitely that feeling of like they're there for you, what you guys are there for us as your clients, and that you're able to service us well. And it doesn't feel like you're lost. Not at all. It doesn't feel like the company's forgotten about you.
Well, we appreciate that. So back to the other two arms. So to give you an idea of just market share in general, through Q2 of 2020, back to the data and the financial numbers, it was estimated that our market share within commercial real estate in general of debt financing was about 13% of the market.
Okay.
So that should give you a scale of how impactful Walker Dunlop has been and how much business we're doing outside of just multifamily as a direct lender.
Okay.
And that's where the other two arms really come into play. So the second one I mentioned is what we call a correspondent lending relationship, meaning we are exclusively corresponding for life insurance companies across the US who are funding commercial real estate loans on all asset classes. So they will fund multifamily, office, industrial, retail, hospitality, self-storage, special use. We financed marinas with them. We financed airport hangars with them. One of my partners has financed the Santa Monica Pier twice with a life insurance company. And so what a lot of folks don't realize is that the major and even some of these smaller and regional life insurance companies that are providing you with whole life policies and disability insurance and even commercial and industrial liability insurance, they're taking those premium dollars in that you're paying them, and then they have to turn around and invest them. And so they're buying US treasuries, they're buying some stocks, and then they're also funding real estate loans because a lot of them find it's a great way to diversify their balance sheet and to find yield. And so the problem is, John Q. Public can't just really call up these insurance companies because that's not how the insurance companies are really built. That's why they correspond through us. So when you want a life insurance company loan through, for example, Symetra, which is the real estate arm of Safeco Insurance, in Southern California, Walker and Dunlop and our team, we are the exclusive correspondents for them. So you would call Walker and Dunlop and say, hey, Andrew, I'd like to explore a real estate loan through Symetra. And you'd work through Walker and Dunlop. Now we will underwrite the deal and present it to the life insurance company, but ultimately they make the credit decisions and it's their money that's funding it. And then on the back end, we service those loans throughout the life of the loan. So Walker and Dunlop, just like we are on Fannie Mae and Freddie Mac, we are involved from start to finish. And if there's ever an issue, a question, and a loan assumption, you sell the property, whatever it might be, you're calling Andrew and his team, who will dig up all the information and make sure that everything goes smoothly over the term of the loan.
It's amazing you guys only have 1,000 employees. I'm just saying.
Like I said, we wear a lot of hats.
You wear a lot of hats. Okay, tell us about your third one.
So the third one is just as a direct, a broker, an intermediary, meaning that we are not funding our capital or our exclusive correspondence capitals. These are national and regional banks, credit unions. These are private debt funds that we are going out to and obtaining bids and loans from, and then connecting our client to them and acting as a broker, just a third-party intermediary helping to negotiate the deal and shepherd it through closing. But ultimately, all of the underwriting and the credit decisions are made by the third-party lender.
Okay, makes sense.
And so typically the way that we're hired is we're hired on an exclusive basis. In the same way that you would hire a broker to list your building for sale on an exclusive basis, you would hire Andrew and Walker and Dunlop to be the exclusive financier. And so you'd say, Andrew, here's the situation. I'm buying this property and I want the best debt in the market. So what that does is that makes us agnostic as to who the ultimate lender is. If we're the direct lender, great. If it's one of our life companies, great. Or if it's a third party lender, great. So long as it's best in market, that's what the service that we're providing.
Now, I always, almost always, I hardly, like I cannot think of the last time I recommended somebody actually go to the, okay, once this last year, I recommended somebody to go to their actual bank that they have a relationship with. It's like a Bank of America or, Union Bank, and go ask them if you can get a loan. Because honestly, most of the time, including even my nephew who recently bought a property, I'm like, no, you need a loan broker. Because a loan broker has the capacity to tap into multiple different streams and multiple different banks to be able to truly find for you and shop for you what are the best terms, as well as being able to manage your particular profile. Because I'm a longtime investor. I haven't held a JOB since I was 29 or maybe 30 something, I think. Probably less than 30, actually, truth be told. But
You're only 29 or 30.
You're a smart man. But basically, it's been a long time since I've had a W-2. And so every time I go for a loan, I personally prefer to use a broker, because a broker has the capacity to say, oh, you're a full-time investor, effectively an entrepreneur. I'm a consultant, as well as I have my own investment portfolio. Here's how we're going to get you financed. And this is a company that's going to not look at you cross-eyed. Last time I tried to go through a regional bank, they looked at my suspended losses on my tax returns, and they said, there's no way we can give you a loan. You have years worth of negative income. And I'm like, no, I have years worth of suspended losses from 2009. I do not have, and I've been stewarding those losses very, very carefully. Thank you very much. Right? By using lots of tax shelters and being able to extend those losses as long as possible. Totally went over his head. He did not understand what I was trying to explain to him. And so again, if it's somebody who's a real estate professional, somebody who wants to buy a real estate based deal, it's something that is commercial, I truly encourage and almost always direct people to find a broker who has access to multiple streams of financing, which is exactly what you're describing.
Absolutely. I couldn't agree more. There are times where that your relationships with a certain bank or a credit union will deliver. And I always encourage our clients, if they have those direct relationships, leverage them, utilize them, and then come to us and we will take on an assignment, and perhaps we're competing against them, right? I mean, that happens all the time. A client will come and say, listen, I've been working with X, Y, and Z bank, and they've provided me an offer, but I'd like to work with you. And if you can add value by improving upon these terms, then the deal is yours. And so that's how a lot of our clients operate. And when we're happy to do it, we prefer to be the exclusive, but sometimes it's just not in the best interest. And we always do what's in the best interest of our client. And
I appreciate that. So let's talk about, again, I can't remember the terminology. My brain is not working today, Andrew. It must be the holidays. But let's talk about responsible financing. Like you can get financing on any property. I have it as part of my mastermind course, right? I specifically have this slide, right? And it's the calculator I use to get a return on equity for multifamily. Is it going to cash flow? What's going to be its total return, right? So I've got, cash flow, and then I've got appreciation. I've got tax benefits. I've got, principal pay down. What's your total return, right? And then I show this total return, right, on this sheet. And the total return is like 20%. It's like, isn't this a great property? Isn't this what you guys want to buy? Isn't this fantastic? And I go, and this is how 2007 happened, right? Because the total return is 20%, but the cash was like 3%. Right. And I'm like, that's not responsible financing. You end up with having a property that as soon as something starts to break in the system, you have to hold the property up. So talk about that.
Yeah. And there's a lot of different mechanisms that we use as a direct lender, and then also as our correspondent lenders use and third-party lenders use now, which safeguard really the system, right? So they're put in place to really limit the leverage that you can put on certain properties. And part of it is a business decision, right? Some property types are just inherently more risky than others. And as such, they do not warrant as much debt as another. For example, multifamily properties have historically, especially over the last 10 and 15 years, been extremely stable cash flowing properties. And so when you look at that and you look at the operations of those properties from a lender's perspective, the risk is much lower than, say, hospitality or hotels, right?
Especially recently, right? Yes.
Especially
But
recently.
even then, hospitality office has a vacancy factor of, I think, close to 20. You can go up to 20%. It's standard. I think standing vacancy factor is something like 10 or 12%. And I'm like, I'm in residential. A standing vacancy of 10 or 12%. I'm like, I wouldn't want to risk on that. Right? So that alone is just an example of the riskiness you're talking about. That's just office. But you were saying hospitality.
Yeah. But really, I mean, the beauty of real estate is just what you said, right? There are so many ways of finding yield. And one of those is leverage, that you don't have to put in 100% of equity like you would if you were buying stocks, right? Where you have to pay cash to get that stock and then you get your return. With this, you can put 25% down and leverage the other 3/4 of the purchase price, which yields to you much more cash flow. But again, responsible leverage is so important, as we've learned time and time again, especially in certain markets and certain asset classes. If it's a boom and bust type of submarket like Las Vegas, or we've seen it in Phoenix, areas of Florida, California experienced it, although I don't know if we'll see that again on the residential side, hopefully not, knock on wood. But what we've seen is when things are prosperous and good, you have to use the same measures and governors of debt that you do when times are bad. And so really what we do as lenders and as we look at transactions and requests for folks is when we underwrite, we put in certain mitigating factors and say, okay, what if this were to happen? And that's a great way for investors to sort of really size a deal and understand if it's a good investment. If the numbers that your broker gave you look good, stress them. What if rents drop 20%? Do the numbers still look good? Does it break even? And if it does, hey, that might be a pretty good investment because there's a lot of cushion and it can withstand a really big market shock like we've just experienced yet again. If not, if the margins are razor thin, like you had used in your example of cash on cash being 3%, right? Or if you lose one tenant, all of a sudden you're underwater. Maybe that's not the right investment for a lot of investors.
One of the things that I like to do, especially in commercial, because sometimes you'll have a ceiling and a floor, right, around the interest rate. And it's like, that's one of the stressors I like to put it through before I book any purchase of property, even purchase a property with that particular loan is, well, what would it mean if I end up hitting the ceiling in my interest rate? Like, is my property capable of doing that? Well, what if it is again, I'm primarily residential, most of what I've owned personally in my own portfolio. And so what would it mean if my 5% vacancy went to 10 or went to 12 and I'm looking at hitting the ceiling of my loan interest rate? What is that going to mean to my property? That's probably the worst negative picture I'm going to be looking at. So that would be the version of negative stress or stressed property that I would want to make sure I understood before I ever closed on.
Absolutely. I'll give you a quick example of some deals that we've done recently for a client. They are going around the country and acquiring large single tenant industrial properties. They buy them cash typically. And so what they'll have is maybe a 200,000 square foot facility in Illinois. And it has one tenant. And if that tenant, it's binary, right? That's your risk. When the tenant's there and paying rent, it's cash flowing and things are good. If that tenant were to leave, you are out and you are not making any money. You probably have to spend money to, put some capital back into the property to spruce it up to get a new tenant. You have to pay leasing commissions, right? I mean, there's capital costs that go into if you lose that tenant. So a lot of lenders don't like to take that risk because it's binary. And so the way that we've gotten creative to finance these projects is they're buying a number of them every year. So we will take 3 or 4 of them, put them together, and then finance them on a cross-collateralized pool. Now, what that does for the lender is instead of having binary risk with one tenant, you have 4 to 6 tenants. And the way that we really have structured them and got it to work is if the largest of those 4 to 6 tenants were to leave, you'd still have a break-even cash flow, meaning that you could withstand the biggest shock and you're still in a good position where you're not underwater on it. And that's how we've gotten them done. And so it's just a good example of sort of diversification of risk, but also, taking something that is actually inherently risky, and finding creative ways to mitigate that and make that financeable within the marketplace.
So I think it's really good examples of your level of expertise and how it can be complex in commercial lending, and how you want to make sure that it is the right terms, the right financing, right, the right cost, but also the right structure inside of the deal itself, on top of the properties that you're looking for, including the particular dynamics of who the buyer is. So I mean, we just went through a couple different stages or levels of things that need to be considered in order to ensure that a particular financial product is the right one for that buyer, for that purchase, for that time.
And for that business plan, right? I mean, that really drives so much of the financing market. Is this a value add that you are then going to sell once you improve rents? Or is this a long-term hold that you are using for estate planning, and it's a legacy asset that you're gifting to your children? And your debt profile should match the business term or the business plan for that asset as best possible. Because if not, it could really put you in a sticky situation later on down the line.
Yeah, and it does, and it can, and it will. I mean, sometimes people want to get a construction loan in order to do a value add on something, but then that loan isn't going to reset into a long-term hold later on, and now they're shopping, but they're still holding the old loan at the higher cost of what it would be to get construction money versus long-term hold money, and that can actually be a big problem in holding that property that way. Okay, so I'm going to switch for a minute. So I'm going to go ahead and switch. So I want to switch over to the concept of financial freedom, because that one is very close and dear to my heart. And when I mentioned it to you earlier, you said you have some strong opinions on that. And I love hearing clear and distinct, strong opinions on financial freedom. So what made you want to use real estate for your financial freedom?
So it really stems back to when I was working for the bank, and really my role was working with wealthy clients and helping them to plan for their future. And so I really got a firsthand look into how people, A, make money, and then B, how they preserve money and how they leave money and leave a legacy. And that was really important to me. And what I really boiled it down to was, if you look at the wealthiest people in the world, they have three assets. They have cash, they have liquid investments like stocks and bonds, and they have real estate. And those three things, a mix of those to diversify, has, made people wealthy and continues to build wealth. And it's wealth that works while you sleep. And that to me is financial freedom, because typically all of these folks, including you and I, we have active incomes. And right now I am trading my time for money. And being financially free to me is now trading time for experiences, time with other people that I love. I don't want to be trading my time for money. So if my assets can create that money for me, I know I that frees up my time, and that's financial freedom to me.
And that makes a lot of sense. Like, my little piece I'm contributing along those lines to financial freedom for estate planning is I have a life insurance policy on my daughter. My daughter, I got it when she was 7. So it doesn't cost me a lot in comparison to the amount of money it will leave someday to my grandchildren and great-grandchildren, depending upon how many years and decades my daughter lives for. And we're pretty healthy people. We generally live into our 90s. So I'm excited about the final value of this insurance policy that I have on her, and how it will help take care of future generations without as much cost to me now. Does that make sense?
Absolutely.
And I don't have to think about it. Like, I've already put it in place. I don't have to think about it. So that's one of those financial assets that you can use, one of those financial tools that you can use to create an estate plan.
Absolutely. But real estate too, I mean, when you look at it and you look at it comparatively, and I told you I have some strong opinions on this.
I want to hear them.
The benefits of real estate comparatively outweigh just tenfold compared to every other type of investment, because not only do you receive cash flow and appreciation if you're in the correct market, but you have tax advantages that you do not have with any other asset classes. So you can shelter that income So you can make the income without paying taxes on it. And then you can also sell it and defer capital gains taxes, which you can't do on any other asset class. And so when you combine all of those together, like your example, maybe your yield, right, or your total return is X, but when you factor into the tax advantages, it could be twice that.
Yes, and it can be, and often and is, right? Principal pay down, right? Tax shelter from depreciation. Those are both things that in your quote unquote financial portfolio are non-cash events for you. And yet they're building your equity every single time.
Exactly right.
So,
and ideally, so right now my wife and I are limited partner investors in real estate.
That was my next question. That's exactly where I was going.
But ideally what we'd like to be is to sort of graduate from that and be principals. Because that's really how you unlock those tax advantages. You get some being an LP investor, but of course you're sharing it with others. And so really to make that next step to buy a fourplex or a sixplex with another couple is sort of our next goal and dream. And that's what we're doing and strategizing for in our budget is saying, okay, where do we need to be? How much income do we need to actively generate to make an investment that will then create passive income for us so we can reduce our need to work actively?
Well, and you personally would be incredibly good at that, whether it's for your own family or whether it's for you and a couple other people you personally would be very good at that. And again, it's my trust and faith in the capacity to run data, right? And being able to plan inside of a longer term market called the economy, right? All ships rise and fall on the tide. Also having the extensive amount of work you've got in underwriting, understanding the difference and the importance in underwriting based upon what asset class you're looking at and what region you're looking to invest in. And the purpose of the investment, what's the business plan of the investment. You bring so much to being able to purchase something wisely and being able to understand its greater good, its greater need. I think you would do an incredibly good job at that for yourself and for others.
Well, thank you.
Yeah. So in case nobody has said that to you, let me say that to you, or if other people have said it to you, let me reconfirm it. Because again, it's the thing I learned late, Andrew, to be transparent, was I learned late the importance of the data. I learned that years after I was investing. Right? Because I started as a pup going, oh yeah, so I own a condo and I own a little townhome and I own these little rental units and I had a job while I own these little, I was not paying any attention to the market cycles. Right. I was not paying any attention. Like even the neighborhoods weren't even that important to me. It was like, oh, well, this looks like a good little condo. That sounds good. I'll buy it. Right. And literally it was things that my family members would bring to me and stuff like that. I was not really responsible, truly not responsible to data, right? And as I learned to become responsible to data as an investor, then it was when I realized the true profound effects that a downturn can have on you. I had lived through one in the 80s because I did own markets, I owned properties, but they were rentals and wasn't paying much attention to them. And I didn't really understand. Oh yeah, it went down by $20,000 or $30,000 or $50,000, but it wasn't meaningful to me because I wasn't calculating my return on equity. I wasn't looking at how much loss I had taken or how large the percentage of loss was. That tells you how non-data driven I was, okay? That I wasn't even looking at my percentage of loss, right? So it's so important to be able to understand the data that's necessary to be a successful investor. So,
and I'm very fortunate because, when I started my career, it was 2010 and we had just seen a huge shock to all real estate values, not just commercial real estate. And so seeing how people were operating in that, seeing the opportunity from that, but also seeing how these valuations had, really just evaporated in 3 years, it was shocking to me. And so it made me say, wait a minute, well, why did they make those investments in the first place? And how can you avoid that going forward? Right? Because there's lessons to be learned. And so I am a very conservative person. I think everyone on my team, including my wife, will tell you I'm usually the person talking back thoughts and deals, right? When they're saying, okay, I think we can get X, Y, and Z. And I'm saying, well, wait a minute, I think it's X minus 1. And here's why. That's usually just it's just who I am. And I think it's good. I think you need both perspectives because oftentimes I'm not going to be right all the time, but I do always want to consider and plan for the worst, even though we're hoping and assuming that we're going to hit a better performer or whatever it might be on any deal, project, budget, whatever it is. But so that really shaped my mindset. And then I'm also just extremely fortunate to work for Walker and Dunlop because they understand that data is the future and that technology is the future in somewhat of an industry that has shied away from technology and data for many, many years. And because we are such a big presence in the market, and because really the value that we bring is on the back end. We have a $100 billion servicing portfolio that includes all of our Fannie Mae and Freddie Mac loans, as well as all of our correspondent loans through our life companies on other asset classes. We take that data and we mine it, and we look for trends, and we look for comparables. And so when a client says to me, Andrew, I'm looking to buy a 68 unit multifamily property in Tucson, I can say, let me check our portfolio and I can tell you how they've operated over the last 10 years.
Right. Actual data on the ground. And because sometimes you can't get, like I use the St. Louis Fed, right? That's a relatively good database, right? You can use Tuesday Morning, right? It's okay database, not great. Some people buy data from John Burns, a good database, right? But if you have that available, if somebody's calling and saying, hey, I'm looking for this particular market, like you said, Tucson, then it's like, oh no, let's give you some specific on the ground, real data on what has been happening and what is happening in that market with multiple assets, right? Multiple buildings. That's valuable data. I have to search and work really hard to get that, or I have to pay $20,000 to John Burns to get that. And I happen to know that's his actual price point, right? So I'm not making that number up. I'm not actually trying to exaggerate. I'm just telling you that's the actual number. If you want to buy a certain amount of data from John Burns, that's the actual going number. And it's an incredible place to buy data. And there are other places you can get data as well. I'm just, this is a short list. But I think it's a valuable asset or valuable data points that you bring to your potential investors who are using you, in that you can give them the current and accurate information. I'm trying to highlight that.
I appreciate that. And one thing that people do is, especially when they're starting off in real estate, they're weighing, should I be investing in locally where I live? Should I go out of state because I can get better yield, right? And so having a little bit of data and thought process behind it really helps people to formulate a strategy and a plan, because you can say, I'm looking in St. Louis, right, for something. Well, why? Well, because my mom lives there or something, right? There's a connection, but there's no real rhyme or reason behind it. But then when I show you that, rent growth has, it's actually been negative over the last 3 years in parts of St. Louis, maybe let's look at Minneapolis or Jacksonville as an alternative. If you have no real tie to it, let's make an informed decision about where the data is pushing people and where people are looking to move to rent because of employment factors and other drivers in that local economy.
Yeah, being able to purchase a property successfully, which is usually the intention, is because it's not always what happens, but to be able to do it successfully usually is a whole series of puzzle pieces coming together. And the puzzle pieces, some of them are soft. I know somebody who lives there. My mom lives there. I grew up there. I have an understanding of the neighborhood. I know who the people are. Like those are soft and hard to quantify, but valuable. But then there's a whole other series of data that is easy to quantify, right? That we keep talking to, right? That is among, a couple of the puzzle pieces are really data driven. Okay, I'm going to push this back one more time. I have one more question before we end up for the day. So you talked to this a little bit, but I'm going to dive a little deeper. Using real estate to become financially free, the value of real estate. You know that if you use real estate to get passive income, that frees up time. What would you do at that time, and how would that feel for you? Why even bother trying to develop a portfolio, having you and your wife sacrifice so you can develop capital to be able to become a principal in a deal? Why bother when you can just be an LP, when you can just continue to do what you're doing and create, some version of retirement? Why bother to be aggressive with it? And what are you hoping for? What would you at the time, and how would it feel?
It's a good question. For me, there's a control piece to it where I want to be the one making the decision, developing the timeline, putting together and implementing the business plan. Whereas an LP investor, you really don't have much say in that. You're along for the ride, and the GP, the general partner, makes those decisions for you. Part of it is estate planning and legacy planning. I want to leave something behind. And I think my wife shares that sort of dream. And we are, right now looking at starting a family. And so these are meaningful conversations that we're having. And an LP is great, but it's sort of minority interest. You own it, but you don't own it.
You don't own it, and you don't have control over it. You don't own it. You don't have control over it. Your returns are limited, and the returns that you've been told you're going to get are often not necessarily completely correct or accurate.
True.
So yeah.
And so for me personally, there's something about being able to touch and feel it and saying, I own this, that is meaningful. And it's something that for me, at least it's tangible enough where I can say, I can pass this on. This is something that will be a cash flowing asset. I will pay down the debt to zero, own this free and clear, fully depreciate it. And then my kids will have, or my grandkids will have a start that, I didn't have. And so that's the way I'm looking at it. So the why is because it's not for me and my wife. I think we can benefit from it. We love to travel. And if we're not actively working, I think we would do that, pandemic aside. And I think we'll enjoy the benefits of it, but really it's a long-term strategy where having a portfolio of real estate assets is generational. It's legacy. It's in places that we want to live and raise our family and, again, put them ahead. So that's my why. It's going to take a lot of time. I know it, but I'm confident that we'll get there and it'll be worth every second that we devote to it.
I am confident you'll get there as well. Okay, Andrew, if anybody wants to get a hold of you, how do they get a hold of you? Your contact information, your cell phone, your size of shirt? No. How do people get a hold of you? How do they find you? Whether it's social media, websites, phone numbers, fill us in.
Sure. So they can always check out Walker and Dunlop on our website, walkerdunlop.com, WALKERDUNLOP.com, or you can reach me directly. My cell number is probably the best way to get a hold of me. It's area code 617-840-2943.
Say that again.
And then lastly, you can also email me. It's my first initial last name at walkerdunlop.com. So AWESTLING at walkerdunlop.com.
Okay, perfect. And anybody who is watching this on YouTube or you're watching it on Roku, you can see the Andrew Westling and the spelling of his name right underneath his picture. And if you're listening to this on iHeartRadio or iTunes or any of those other platforms, that's why Andrew spelled it all out for you. Andrew, thank you so very, very much. I so appreciate you spending the time here today and being able to do this interview with me. I hope things go beautifully in the year of 2021. We don't normally date our shows, but since you're wearing the Walker Dunlop 2020 Drive Towards 2025 on the back, right, I can't help but date the show. And I'm sure I will see you around in our communities, which seem to overlap often. So,
Christina, so nice to see you. Thank you. Happy holidays.
Happy holidays.
New Year. I hope for a very prosperous 2021, and I'm sure we'll get together soon.
I'm sure we will. I am Christina Suter, your host of the Real Estate Breakthrough Show. You can find out lots about my show and other information about me on Christina Suter, SUTER, ChristinaSuter.com. Thank you for listening.